Good morning and welcome to Morning Markets. It's Thursday, the 11th of June. My name is Paul Durrans and I'm one of the investment directors here at True Potential. So the big event over the last 24 hours has been the statement from the chairman of the Federal Reserve, Jay Powell, who he and the rest of his committee members concluded their two-day monetary policy committee. As always, these meetings get a lot of attention from investors and market participants as their actions or lack of actions can materially influence the direction of financial assets such as stocks and bonds. Compared to recent meetings over the last few months, this one was relatively uneventful with no significant policy changes, but did offer some useful insights. The announcement reinforced the Federal Reserve's commitment to maintain a smooth functioning of markets by continuing to purchase US Treasuries and commercial and residential mortgage-backed securities at its current pace, which is around $40 billion a month for mortgage-backed securities and $80 billion a month for US Treasuries. So this is good news, really. They're continuing to support the flow of credit to businesses and households, and they're willing to do more should they need to. Back in March, the Fed took an unusual step, which was to suspend its economic growth forecasts due to COVID-19, the uncertainty that brought, and the real difficulty of making any forecasts at that time. They made forecasts this time for their economy, and they expect US GDP to contract by 6.5% this year, but this would rebound over the next coming years, growing 5% next year and 3.5% in 2022. Unemployment rate is expected to remain elevated at 9.3%, but is expected to trend lower over the next coming years. Yesterday, we also saw the latest US inflation print number coming in at 0.1% in May, which is down from 0.3% in April, which was primarily driven by the lower oil prices, which we've seen over the period, and we've talked about that in previous months. If we look at core CPI, which excludes the volatile energy prices and food prices, inflation came in at 1.2% in May, which is down from 1.4% in April, and core CPI has been trending lower due to the drop-off in airline fares and drop-off in lodging costs. With that, clearly there are no real inflationary pressures coming through anytime soon, and so the Federal Reserve has maintained its ultra-low interest rates at 0 to 0.25%. And they expect that the guidance they have given is that they expect those interest rates to remain at those levels right up until 2022. With interest rates expected to stay low, you've seen movements in the bond markets, particularly in US Treasury yields, which have fallen from 0.79 to 0.7 over the past 24 hours. So a positive return for investors owning US Treasuries, and we certainly have some of those within the portfolios. The S&P 500 closed down 0.5% after initially rallying following the statement from the Federal Reserve. Over the past couple of weeks, we've talked about the broadening out of stock market returns to areas such as cyclical and value sectors such as banks. However, yesterday we saw some weakness as the expectations for lower interest rates and lower growth forecasts has shown some weakness, has proved to show weakness in some of these areas. Overnight and into this morning, stock markets have shown weakness globally. So in Asia, Europe and UK are all trading lower, which is understandable in some ways given the strength of stock markets over the past real week. over the past few weeks, it's not surprising to see a bit of a pullback. But we have seen some strength in those more uncorrelated assets or uncorrelated to equities, such as gold and UK gilts, who have both strengthened over the past 24 hours. So that's everything from me. Thank you for listening, and we'll see you next time.